Howdy, Jacob here. Today we're looking at Balchem Corporation, company 92 in our generic stock screener, 4.9 billion market cap on 5.1 billion enterprise value in the chemicals industry, and a little bit of a dividend there, 79 cents, 0.5% yield. Growth has not been immense. It looks like, I presume this might have been an acquisition, otherwise pretty slow growth, but still mid-single digits, so nothing, so not too bad, honestly. And we do see capital expenditures a bit higher more recently. I wonder if something changed in their reporting to where it moved to here, I'm assuming, but even still, much better production of cash from operations, so that's great. And like I said, 2014, that big jump, 491 million acquisition, so that's part of this revenue jump there. Otherwise, use of cash, a little bit of acquisitions. Their dividend only pays out about $26 million in aggregate, which is really about 20% of their 5-year average free cash flow. So a very reasonable payout ratio. Reduction of debt with a bit, share repurchases a little bit. So majority of their free cash flow is going towards acquisitions. Let's look at that balance sheet. We saw a little bit of net debt. So 64 million cash on hand with no short-term debt, but 310 million long-term debt. They are producing quite a bit more free cash flow than 8 years ago, 9 years ago, and their debt is about the same, maybe a little bit higher, but much better production of free cash flow. So from a leverage ratio, or from a ratio of free cash flow to debt, not as bad there. So, I mean, I think we're ready to start making some assumptions here. I don't think I need to look at anything else. So on the revenue growth side, maybe 3-4%. Well, let's say 4%. So maybe they grow relatively in line with inflation, possibly even less, but then they make some acquisitions that are going to be beneficial for them. The margins have gone up, but are relatively flat over a 9-year period. So pretty similar there. I'll stick pretty close to the averages. And then for share change, let's see, stock-based compensation, 16 million. Let's just say they offset that. So pretty much no share change. P for a company growing 4%, those types of margins. A little bit of the growth from acquisitions, though. I'll just put them in with the market average. And then the final thing is dividend. I mean, they can definitely afford that. They've been increasing that 10% a year. I think I'm comfortable with that. Because even by the end of 7 years, with them growing 4%, their dividend payout's probably still going to be under 40%. So really not a concern there. We're saying that they use a bit of acquisitions to get these types of revenue growth and margins. They don't really reinvest a lot. They have enough share change to really offset stock-based compensation, nothing more. And then their dividend of currently about 20% payout. Let's say they increase that 10% a year. And we're saying it's a bit expensive, about 80% drop required before you get the return we're looking for. I mean, it does make sense to me. Their margins are pretty much in line with history, and they have a 40 PE. I really just personally don't think the growth is there to give you the return you're looking for at this price point. Not saying there's not a price point. Obviously, I think every positive free cash flowing company deserves some sort of valuation, but at this one, I just think you're getting at a bit expensive price personally. So hopefully you enjoy the video, guys.